My name is Philip Lee from Morgans Financial, and it's my pleasure to bring this edition of WAM Vault to you from Brisbane. I'm delighted to have with me a man who needs little introduction, Geoff Wilson, Chairman and Chief Investment Officer of Wilson Asset Management. Geoff, welcome to Morgans today.
Thank you.
Look, this edition of WAM Vault is focusing on the recently listed WAM Strategic Value Fund, or WAR, which listed after a really successful $225 million capital raising. Geoff, for over 4 decades, you've focused on identifying and investing in discounted investment opportunities, in particular in the listed investment company and listed investment trust sector. This year, you consolidated all your activities into WAR. What prompted you to do that, and what have you been able to achieve since bringing it together and listing?
I suppose the interesting thing is, myself, like yourself, and like everyone who's an investor, we all like to buy $1 of assets as cheaply as we can. Being value investors, whether you can buy $1 for 50 cents, it's exceptional. In the listed investment company trust and the trust and company space, occasionally you can buy $1 of assets for 80 cents or 85 cents. And what we thought, it just made sense as the business has grown that we allowed people to have that direct exposure to undervalued assets, and that's why we created WAM Strategic Value, or it trades under the ASX code WAR.
Fantastic. Look, there are over 100 LICs and LITs and other closed-ended funds listed on the ASX with a combined market cap of over $50 billion, so it's a sizable sector. What's the current landscape of that sector, and what are you seeing at the moment?
I mean, the interesting thing is when we talked about floating WAM Strategic Value, there was quite a bit of interest in the whole sector, and the discounts narrowed. More recently, there have been some discounts have opened up again. We're very happy with our portfolio. We're holding about high 20% of the portfolio currently in cash. Just looking for some very specific strategic opportunities. I do think there'll be further rationalisation in that sector over the next 12 months, and we will be involved in that.
Can you give us any examples of what you've done recently?
Well, it's the listed investment companies that do trade cheaply. I mean, one that we've been buying recently is VG1. Trading, I think we're buying it the other day at a 16% discount to NTA. So you're getting exposure to that fund manager, and instead of paying, the professional investors that give them money are paying $1, and we're paying, say 84 cents, which to me is exceptional value.
Fantastic. And what about the consolidation of the sector? Do you think there's too many?
There's definitely not too many listed investment companies. The number of listed investment companies probably doubled in the last 4 or 5 years. They will continue to grow. It is a great sector. There's a lot of demand for these type of products because there's a lot of there's transparency. You've got board of directors that are accountable. The investment manager is accountable, and we've seen, and that's what's resulted in some of the changes in structures more recently. And for the investor, you're getting exposure to a growing stream of fully franked dividends. And what we find is, with our investors, 60 to 65% of our investors are self-managed super investors. So, it is a very attractive investment vehicle.
So the ability to deliver a steady stream of income to these investors is critical in your...
Well, that's right. I mean, first of all, obviously the fund manager has to perform. And secondly, when he performs, then he can provide a growing stream of fully franked dividends. Also, he, like all, people that run companies, they've got to treat shareholders with respect. And probably the fourth thing that a lot of newer participants in the space don't realise is they really have to have a very detailed shareholder engagement, communication and marketing strategy. And that's where a lot of people fail. And we try to do that. And we also understand that the shareholders, we as myself being a chairman of the company or being on the boards, we're only there because we're there to represent shareholders. And so the shareholders that own shares in the company, they own the company. So it's very important that they communicate to us, what they see, what they want us to do. And that's where, unfortunately these days, a number of boards of big companies, the directors think they're there because the other directors put them on there. Why they're there is to perform on behalf of all shareholders. So that's something that people have to realise.
Of course. Now, you talked about the growth of the LIT and the LIC sector. The other sector that's grown strongly has been the exchange traded fund or ETF sector. What's the key difference, and why would people invest in an LIC or an LIT with Wilson Asset Management as opposed to getting an exposure through an ETF?
Well, looking at the ETFs, versus the listed investment companies or listed investment trusts, ETFs will always grow at a significantly greater rate because they're an open-ended pool of capital. Where a listed investment company, one of its, the big positives or a listed investment trust is they're a closed-end pool of capital. So, once they've done their IPO, then they start with X amount of capital and they have to invest that. They don't have money coming in or going out at various points in time. Where an ETF's open-ended, so if people want to put money into the ETF, then it grows significantly. The ETF also is a trust structure where the listed investment companies are a company structure. And with the company structure, that's where you can get a growing stream of fully franked dividends, and which is very appealing to people that want that growing stream of fully franked dividends over time, and self-managed super players. And with the ETF, you're getting distributions, and they have all different tax consequences. And I know the ETFs have been embraced by the millennials, and I was talking to someone the other day, and they said there's starting to be a little bit of pushback because the millennials thought they were investing in an ETF and that was it. Then all of a sudden they get a complex tax distribution, and also boards are accountable. Where with a company you have a listed investment company, a board that's accountable. Where an ETF, it's just another trust and there's an RE.
Fantastic. Well, more generally, look, as we approach the end of 2021, have any of your views on the equity markets changed? We've had very strong overseas markets. We're seeing a big part of our economy about to reopen, coming out of lockdown, but we're also seeing signs of early signs of interest rates rising, particularly with commentary out of the RBA. How are you seeing things from Wilson's perspective?
What surprised everyone was when COVID hit, how quickly the market bounced back. I remember I was doing a presentation in February, the year that COVID hit, and I remember in that presentation we talked about things going back to normal eventually. They will normalise, and that's where we're in the process of the economies getting back to normal. Obviously there's been a lot of pent-up demand that's going to be that will fuel the growth in those economies, and we're aware of that and we're seeing that. We've had record interest rates. As you mentioned, the risk is now we're starting to see a little bit of inflation and interest rates start increasing. What does worry me is we have had a very, very strong equity market. I was taught in the early 80s when I started working in the equity market that you make your money in the second bull market. And I sort of didn't understand what that meant initially. What that means is on the first bull market, whatever money you make, you lose because you've taken nothing off the table. And it's really your second bull market that you realise that when markets have been strong for a long period of time, you've got to make sure you've taken some off the table. With the equity markets at the moment, we have had a very strong equity markets over a period of time. Last year, I think the Australian market was the best performance in 34 years. This year, it's been a strong start to the equity markets as well. So, there is a lot more risk than there was on the table. So, to me, it's really about making sure you've got your portfolio positioned. So, if the market was down 20 or 30% overnight, then you could sleep at night. No one knows where the market top is. All I know is the market's been very strong. It looks like it'll continue to go up, but there are, it has some signs of, there are some signs of excess.
Signs to be cautious about. But finally, Geoff, it's been great to talk with you. What can we expect from the WAM team as we look forward to 2022?
Well, the WAM team led by Kate Thorley, our CEO, does an exceptional job on the investment side. You've got Oscar, Katrina and Matt running the various teams, and with all the teams, their performance in 21 has just been first class. They've all performed. More recently, Danya has joined us on the alternate space, has really done a good job with WMA. Going forward over the next 12 months, with a bit of luck, with a bit of experience, I just hope they continue to perform as they did last year, because as a shareholder in all the entities and on behalf of all shareholders, I'm sure we'd all like to thank them for doing an exceptional job.
Well, that's well put. And Geoff, look, thank you for joining us today. Congratulations on a very successful and well-timed issue, raising $225 million for WAR has been a testament to you and your following. So congratulations, and thanks for your comments today.
Thank you.